Welcome back to the channel. Today we are diving deep to the world of demand guarantees and standby letter of credit. These financial instruments are crucial for international trade, construction projects, and variety of industries. If you are ever been curious about how these tools work or why they are important, stay tuned. Let's start with demand guarantees. So, what exactly is a demand guarantee? It is an irrevocable undertaking issued by the guarantor, usually by a bank or institution, to pay the beneficiary a sum of money up to a maximum amount of the guarantee. But payment is only made when the beneficiary presents a demand in documentary form that complies with the terms and conditions of the guarantee. Now, a demand guarantee has to be in writing. It can be in paper or electronic form. If it is on paper, the document should be signed. If it is in electronic form, like SWIFT messages, the issuer's identity must be authenticated. This is because SWIFT messages are automatically authenticated, making them a reliable option for demand guarantees. However, a fax or PDF copy might not be enough without an original signed document. The guarantor will only issue a demand guarantee upon instruction from the applicant or the instructing party. A key feature of demand guarantees is their independence. The guarantor's obligation to pay the beneficiary does not depend on the underlying relationship between the applicant and the beneficiary. This means the guarantor does not need proof of a breach to make a payment, as long as the beneficiary's demand complies with the guarantee's terms. For example, the guarantee might require a signed certificate and other specific documents. Now, let's talk about standby letter of credits. A standby letter of credit functions similarly to the demand guarantee. It is an irrevocable undertaking by the issuer to pay the beneficiary upon presentation of a complaint demand. Just like demand guarantees, standby letter of credit must be in writing and either in paper or signed or authenticated electronically. Again, SWIFT messages has play a huge role here. But here is the key difference. While both instruments are documentary, meaning they are payable against the presentation of documents, the documentary credit is a primary payment mechanism. In contrast, the standby letter of credit is a protection against a default in payment or performance. So, it is essentially a backup plan. So, why are these tools important? Demand guarantees and standby letter of credits are essential for businesses. They are frequently used in industries like international trade, construction, insurance, shipbuilding, and manufacturing. For example, if two parties enter into an agreement, one might want a guarantee that the other will perform their obligations or pay any amount owed. Instead of requiring cash deposit to cover the risk, the parties can agree that the applicant's bank issues a demand guarantee or standby letter of credit to protect the beneficiary from non-payment or non-performance. These instruments typically come into effect right before or just after the start of the transaction. They are irrevocable, meaning they cannot be changed, and they are remain in force until the specified expiry date or event. For example, an advance payment guarantee might require confirmation of payment before the beneficiary can make a demand. So, what type of demand guarantees are there? Broadly, we can categorize them into two types: payment guarantee and performance guarantee. Payment guarantees cover risk like non-payment for delivered goods. For instance, an advance payment guarantee ensures the buyer can get their money back if the contract is not fulfilled. Financial guarantees cover payment obligations in banking, finance, and insurance. On the other hand, performance guarantees, also called performance bond, cover the risk of the applicant failing to fulfill a contract. Other examples include warranty guarantee, which protect against breach of warranty for goods or services, and tender guarantees, which protect against a bidder failing to sign a contract after winning a tender. Sometimes, both parties in the transaction might need to issue demand guarantees. In fact, multiple guarantees can be issued for the same deal. For instance, if a party A is building a ship for party B, party A may need to arrange several guarantees: a performance guarantee, an advance payment guarantee, and a retention money guarantee to cover different stages of the product. Meanwhile, party B might need to issue a payment guarantee to cover the installments due under the contract. So, as you can see, these guarantees play a critical role in ensuring both sides are protected. To wrap up, demand guarantees and standby letter of credits are powerful tools in business, offering protection against non-payment and non-performance. They are specifically useful in high-stakes industries like construction, finance, and international trade. If you found this video helpful, be sure to like and subscribe for more deep dives into financial instruments and business topics. And if you have any questions, drop them down the comment below. Thanks for watching and see you in the next time.